The adoption of cryptocurrency by traditional finance is one of the most exciting trends in the financial world, reflecting a significant shift in the way money, assets, and transactions are viewed and handled. Here's an overview of how this adoption is unfolding, the key players involved, and the implications for the future of both industries. Traditional financial institutions, such as banks, hedge funds, and asset managers, have increasingly moved into the cryptocurrency space. This is seen in Bitcoin and Ethereum ETFs. The launch of exchange-traded funds for Bitcoin and Ethereum has allowed investors to gain exposure to cryptocurrencies through regulated financial products. These ETFs make it easier for institutional and retail investors to participate in the crypto market without directly purchasing and holding the assets. Corporate treasury holdings, companies like Tesla, MicroStrategy, and Square, have made significant investments in Bitcoin, using it as a hedge against inflation and to diversify their balance sheets. Crypto as a store of value. Some traditional institutions see crypto as a digital gold and part of a diversified portfolio, while others view it as a potential future replacement for traditional reserve currencies. Banks are increasingly offering cryptocurrency-related services, either through partnerships with crypto companies or by building in-house capabilities. For instance, custodial services. Banks like JP Morgan, Goldman Sachs, and Morgan Stanley have started offering crypto custody services for institutional investors, helping them store their digital assets securely. Trading platforms. Many financial institutions are either providing or working with third-party services to offer crypto trading on their platforms. JP Morgan, for example, allows clients to trade Bitcoin futures, while Fidelity launched a platform for cryptocurrency trading and custodial services. Blockchain for payments. Traditional payment giants such as Visa, MasterCard, and PayPal have integrated blockchain and cryptocurrency capabilities into their existing systems. PayPal, for example, allows users to buy, hold, and sell Bitcoin and other cryptos directly from their accounts. As cryptocurrencies become more mainstream, regulatory bodies in various countries are beginning to clarify their stance on crypto. This provides a framework for traditional finance institutions to participate safely and legally. Global regulatory push. The European Union, the United States, and other nations have started drafting clearer regulations around cryptocurrencies, ranging from anti-money laundering requirements to know-your-customer obligations. Taxation and reporting governments are focusing on how to tax crypto holdings and transactions. This will require traditional financial institutions to integrate crypto reporting into their services. Regulatory sandboxes. Some countries, such as the United Kingdom and Singapore, have created regulatory sandboxes where crypto and blockchain projects can operate under relaxed regulations to test new products in a controlled environment. Traditional financial institutions are exploring and investing in blockchain technology, not just for cryptocurrencies, but for various financial applications. This includes cross-border payments. Blockchain can enable faster and cheaper international money transfers. Ripple's XRP, for example, is designed for real-time global payments, and many banks are testing this technology to improve settlement times and reduce costs. Decentralized finance, DeFi. While not directly a part of traditional finance, decentralized finance protocols have gained attention for their ability to offer lending, borrowing, and trading outside the traditional financial system. Major institutions are exploring ways to bridge these decentralized protocols with their centralized systems. Smart contracts. Banks are exploring the use of smart contracts, self-executing contracts with the terms directly written into code, for automating processes like clearing and settlement, derivatives trading, and syndicated lending. Despite the rapid growth, traditional finance's adoption of crypto faces several challenges. Volatility. The inherent volatility of cryptocurrencies makes them a risky investment. Traditional financial institutions, which are generally risk-averse, may be hesitant to embrace crypto in their portfolios. Security and custody. Security concerns, including hacks and theft, remain a major issue. Securing private keys and protecting assets against cyber attacks are critical challenges for banks and institutional investors. Public perception and skepticism. Traditional finance has been slow to accept crypto due to its association with criminal activity and its lack of regulatory clarity. Public perception, especially after incidents like the collapse of FTX, can affect mainstream adoption. Technological complexity integrating crypto into traditional finance systems requires significant investment in new technologies, talent, and infrastructure. Tokenization of assets. One of the key innovations where traditional finance and crypto are converging is the tokenization of real-world assets. This includes stocks, bonds, real estate, and even art. Tokenizing these assets on a blockchain can reduce transaction times and costs and enable new investment opportunities. Central Bank Digital Currencies, CBDCs. Many central banks are exploring or have already launched their own digital currencies. CBDCs could bridge the gap between traditional finance and decentralized cryptocurrencies, offering a state-backed alternative to private crypto assets. Continued collaboration. We are likely to see more partnerships between traditional financial institutions and crypto-native firms, such as custodians, exchanges, and DeFi platforms. This would help bring more liquidity and institutional-grade services to the crypto space. Convergence of crypto and traditional assets. We may see the integration of traditional and digital assets on the same platforms. Traditional stock exchanges like the NYSE or CME could offer trading of tokenized assets, while crypto exchanges might begin listing traditional financial products such as stocks or bonds. The integration of cryptocurrency and blockchain technology into traditional finance is still in its early stages, but the trajectory is clear. Both sectors are on a path to greater convergence. While there are challenges, such as regulatory uncertainty and volatility, the opportunities for innovation, efficiency, and financial inclusion are significant. The growing involvement of institutional investors, traditional banks, and fintech companies signals that crypto will likely play an increasingly important role in the global financial ecosystem in the coming years.